Hello, good evening, ladies and gentlemen. I'm Timothy Marbun, and on behalf of the Indonesia Deposit Insurance Corporation, I would like to welcome you to our event tonight. This year, the Indonesia Deposit Insurance Corporation, or IDIC, is holding its annual international seminar as a webinar entitled Maintaining Financial System Resilience to the COVID-19 Black Swan, Deposit Insurance Strategic Responses and Policy Options, to commemorate the 15th anniversary of the Indonesia Deposit Insurance Corporation. As we are mindful about the current unprecedented situation of the pandemic, IDIC brings forth this webinar along with prominent and reputable speakers in the field, which aims to exchange knowledge and ideas on top of bringing conducive and fruitful discussions to the table in respect to the strategic responses and policy options of regulators, especially deposit insurers, to sustain the resilience of financial system within our respective countries. Tonight's event is also organized as a commitment of IDIC in preserving public trust in the banking industry. It is an honor to host our webinar tonight, and we have a packed 2 hours ahead of us where we will hear a welcoming remark from Dr. Halim Alamsyah, the chairman of Indonesia Deposit Insurance Corporation, followed by a keynote speech from the Honorable Dr. Sri Mulyani Indrawati, Minister of Finance of the Republic of Indonesia. Further on, Mr. Henry Wibowo, Executive Director, Head of Indonesia Research of JP Morgan, will moderate our panel discussion tonight. Mr. Wibowo is also a committee member of Indonesia Deposit Insurance Corporation. And our esteemed speakers for tonight's discussions are Mr. Hassan Zaman, Regional Director, East Asia and Pacific for the Equitable Growth, Finance and Institutions Vice Presidency of the World Bank. Mr. Arthur J. Merton, Deputy to the Chairman for Financial Stability, Federal Deposit Insurance Corporation. Mr. Yuri Olegovich Isaev, General Director of the State Corporation Deposit Insurance Agency of Russia. Ladies and gentlemen, we would like to invite everyone to join our discussion tonight by submitting your questions through Slido. You can scan the QR code on your screen, where you will then be connected to Slido to submit your questions. Use the hashtag IDIC to retrieve the Q&A page. We also seek your valuable input by completing a quick survey that has been prepared by the committee, and it is also available through Slido through the same QR code. For those wishing to retrieve the presentations on tonight's discussion, a separate QR code is available on your screen. You can scan the QR code and download these presentations, or you can access it through the web address stated on your screen. Ladies and gentlemen, the event today will start with a welcoming remark from Chairman of the Indonesia Deposit Insurance Corporation, Dr. Halim Alamsyah. Mr. Alamsyah, the screen is yours.
Bismillahirrahmanirrahim. The Honorable Ibu Sri Mulyani Indrawati, Minister of Finance of the Republic of Indonesia, the Honorable Mr. Hassan Zaman, Mr. Arthur J. Merton, Mr. Yuri Isaev, and Mr. Henry Wibowo, distinguished participants, ladies and gentlemen. Assalamualaikum warahmatullahi wabarakatuh. A very good morning, good afternoon, and good evening to all of you. First of all, I would like to praise the Almighty for His blessings, that we can all gather here in this delighted moment. On behalf of IDIC, I'm delighted to open the Indonesia Deposit Insurance Webinar, and would like to extend to all of you our warmest welcome and sincerely thank to the all eminent speakers, moderator, and guests from all over the country for taking your time out of your busy schedule to attend this webinar, to share thoughts and opinions on financial related issues. It is, of course, our privilege and honor to have you all here, even though virtually today. I would like to take this opportunity to especially express our utmost appreciation to the Honorable Minister of Finance of the Republic of Indonesia, Ibu Sri Mulyani Indrawati. I'm pretty sure she is really very busy and we are very truly fortunate to be able to hear she is going to deliver the keynote speech. And I also want to express my gratitude to our prominent speakers from the World Bank Group, Mr. Hassan Zaman, and from the Federal Deposit Insurance Corporation of the United States, Mr. Arthur J. Morton, and also from the Deposit Insurance Agency of Russia Federation, Mr. Yuri Isaev. Also, I would like to thank to our moderator, Mr. Henry Wibowo, which is also one of our information committee members in IDIC. I do really believe that the information shared by such distinguished speakers would give insights and share thoughts on how we, as financial regulator and practitioners, could hand-in-hand combat the COVID-19 pandemic effectively and maintain the stability of our respective financial system. Distinguished guests, ladies and gentlemen, as we all know that this pandemic has greatly taken toll on human lives and caused tremendous suffering to many people around the world. The impact of this pandemic has spread to reach the global economy, financial markets, trade, and also global supply chains, hampering growth and development and reversing the gains accomplished in the previous years. This human crisis, in a way, requires a global response, and the world counts on us to come together and cooperate in order to face this challenge. Policies and measures have been taken in response to this pandemic to restore the economy. I believe our prominent speakers can share the measures and policies that have been taken by the respective countries in order to revive the economy. However, please allow me to take a minute of your time to share highlights of responses taken by deposit insurers around the world in dealing with the pandemic. The International Association of Deposit Insurers noted that since the occurrence of the pandemic, the information sharing between safety net participants has been enhanced. Several relaxation on the deposit insurance program requirements, such as time extension for premium payments and data collection, have also been introduced. Also, monitoring of bank conditions has been intensified, and greater efforts in public awareness and communication have been made by members. On top of that, depositor reimbursement and resolution readiness has been also prioritized. Distinguished guests, ladies and gentlemen, the government of the Republic of Indonesia itself, like any other government around the world, has taken several initiatives to withstand the COVID-19 pandemic and minimizing its impact to the demand side and the health sector. The government has also provided incentives to maintain resiliency of the supply side, as well as preserving the confidence level within the financial market, especially within the banking industry. And as a prosperous, stable societies and a healthy environment are the bedrock of political stability, economic growth, and flourishing new markets, everyone has a role to play. Therefore, every authority in the country takes important part in the nation's attempts in combating the COVID-19 and its impact, especially in safeguarding the economy and maintaining stability of the financial system and banking system. On that note, IDIC has also taken a significant role in it, such as by initiating banking strategic discussions with the central bank and the Banking Supervisory Authority Fellows, collecting data and information, especially on the affected banks in timely manner, and prudently preparing ourselves for any potential resolution action that we need to take when there is a failing or failed bank. Correspondingly, the government of Indonesia has enacted Law Number 2 of 2020 on State Financial Policy and Stability of Financial System for the management of coronavirus disease and or countering the threat to national economy and or stability of the financial system. The law has strengthened IDIC in many ways, especially in terms of deposit insurance programs, in terms of bank resolution authority, and also providing funding, alternative funding. Distinguished guests, ladies and gentlemen, before ending my remarks, I would like to quote Dorothy Gale in The Wizard of Oz. The quote is, "We must be up inside the cyclone." By this, I hope that every one of us would all work together and put our best efforts overcoming this pandemic and move forward to a future where all people thrive, prosper, and healthy. With that, I thank you for your attention and your presence here today. Albeit virtually, I could still feel the warmth of enthusiasm from all of us. By that, I would like to greet again. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you very much, Mr. Halim Alamsyah, for your welcoming remarks. Esteemed guests, next is a keynote speech from the Honorable Dr. Sri Mulyani Indrawati, Minister of Finance of the Republic of Indonesia. Minister Sri Mulyani, the screen is yours.
Thank you very much. Assalamualaikum warahmatullahi wabarakatuh. Very good morning, good afternoon, good evening for all of you, especially the speaker, Mr. Arthur Norton, Mr. Yuri Isayev, and my colleague Hazan Zaman, and all other participants of this webinar. I would like to first express my appreciation for the Deposit Insurance Corporation Indonesia, who's conducted this international seminar in a very timely and also discussing a very important issue, which is now becoming the focus for many policymakers in dealing with the COVID-19. Dear distinguished guests and all participants, we are all now in the middle of fighting COVID-19. As of today, more than 29 million people affected, and the casualties already reached more than 900,000. This is the issue maybe more than just once in a lifetime. So very unprecedented, extraordinary, and that's why there should be a lot of what you call it exceptional policy response that need to be done by many countries in dealing with this extraordinary situation. COVID, as we are all knows, is a threat on health and the safety of the people. And in all countries in the world, the safety and security of the people is always the priority number one. So you cannot compromise on that. And of course, dealing with the COVID-19, because of the nature of the disease, we have to do a lot of restriction, both social and economic, that definitely then create a severe trade-off by many countries in the world to choose between the two impossible choices. Whether you are going to save people because of the threat of COVID, or you have to save people livelihood on job as well as their income because the threat of unemployment and the economic situation which is contracted very severely. So this is a real challenge for any policymaker all over the world. The issue of COVID is now becoming, we are entering almost 7 months for Indonesia, for other countries maybe also earlier. And we do understand that the domino effect of COVID-19 from the health issue to become a social challenge, social issue, social problem, economic challenge, then the threat to the financial stability is very real. For Indonesia, this is again remind us, although we have experienced the crisis before, as I mentioned earlier, in 1997 we have a banking crisis leading to the political and a crisis that changed the country fundamentally. to the most recent like global financial crisis in 2008-2009, this COVID-19 presented a totally different challenge, although some of the implication is similar to the previous two crises. Unlike the two previous crises, this time the health and the safety of the people is really at stake. And in order for us to be able to handle the health threat, we really have to sacrifice on the economic side, both on the demand side and the supply side, which is becoming paralyzed, unprecedented. So how Indonesia dealing with this issue? First, at the early stage of this COVID coming to Indonesia, we recognize that this is going to be a challenge which is affecting the whole economy. And that's why we also look at how we are going to design the policy and instrument, as well as the discussion among the Financial Stability Committee in order to identify the potential domino effect of the COVID-19 into the stability of the financial system. As mentioned by Mr. Halim Alamsyah earlier, that President Republic of Indonesia submitted the Emergency Law number 1, 2020 to the Parliament for us to be able to deal with this COVID-19. These are all the emergency law, which is consisting all steps necessary for us to use our state finance, fiscal policy, our budget to respond to the COVID in an unprecedented way. Some of you may be familiar with Indonesia, others may not. But Indonesia in the past more than 15 years has already adopted what we call it fiscal discipline rule, which is allowing the country, the government to only have a deficit less than 3% in one fiscal year. And to also have a cap on our debt to GDP ratio not to exceed 60% of GDP. With the COVID, we all know that with the paralyzing economic activity, the revenue of the government in the form of tax or non-tax revenue will be collapsing. If you combine even with the commodity price drop, we recall that oil price even have a negative price even though only 2 days. That was an extraordinary situation. So for all countries, revenue definitely will be affected in a negative way. While the pressure for the spending is being escalated, especially in dealing with the health spending, protecting the people to the social protection scheme, and supporting the business community, including and most importantly the small and medium enterprises. That's why for Indonesia in designing the response of this COVID-19, we are addressing all those challenges in a relatively, hopefully, comprehensive way. It's not always perfect because we design in an emergency with a very fast process and with the understanding of what we are going to expect in the next 2 or even 3 years. Our emergency law allowing government to have a deficit more than 3% for 3 years. And we end up with a 2020, our deficit has been widened very significantly. Originally, our budget is actually designed with a deficit only 1.7% of GDP. Currently, we are having the deficit which is close to 6.3% of GDP. This deficit mainly to accommodate the health spending, social protection which is expanded very widely to cover in even almost close 50% to protect almost 50% of the population, support for the small and medium enterprises, as well as support of the business community through the incentive of the tax break and other incentive. This kind of measure also include the design to recover the economic activity back to hopefully normal trajectory. This kind of design in order also for us to be able to protect the demand side, or at least to cushion the collapsing on the demand side, be it in the consumption, investment, or to some extent also export. And at the same time, protecting and strengthening the resiliency of the supply side or production side in Indonesia. This kind of response cannot be done by the government alone. So the government of Indonesia, in this case Ministry of Finance, have to work within the Financial Stability Committee, that is with Bank Indonesia as a central bank, Financial Sector Authority, OJK, and the Deposit Insurance Institution, LPS, in order for us to also design what is the policy response and anticipation of this COVID-19 that can threaten the stability of financial system in Indonesia. With the government extraordinary fiscal measure, Bank Indonesia also do their part. They cut the Bank Indonesia 7-day reverse repo by 100 basis point, and also by relaxing the macro-prudential intermediation ratio and the reserve requirement. OJK providing policy for relaxing financial institution, which is allowing bank to be able to restructure and also having their reserve requirement for their capital in order to support the weakening performance of their credit. These are all for all of us to be able to create a space for the public as well as the economy, including the corporation and banking system, to adjust to this extreme shock. After the very volatile months that we are all witnessing, with the panic of the global environment due to this pandemic, we saw and witnessing the volatility in the financial sector globally, which can potentially creating an exogenous shock and threatening the stability of any financial institution. For example, the CDS 5 years in Indonesia increased by 282 basis points in early March, from 67 in early 2020. The foreign investors is also selling off more than 140 trillion rupiah, which is around 10 billion in a very sudden outflow, which is threatening the stability of the economy. Following that, certainly the stock as well as the exchange rate under a huge pressure. This situation becoming one of additional threat in addition to the COVID itself, for us to be able to manage and to maintain the resiliency and the stability of the financial system. So with all those measures and the coordination made among the financial authority, Indonesia currently able to restore some, what you call it, calmness and hopefully recovery of the economy. Our PMI has been recovered from a steep decline into now nearly or exceeding just the threshold of 50, indicating that the manufacturing sector has started to then work and function again. Our global mobility index, the Google mobility index of the people who's now doing their activity, is also supporting the recovery of many sectors from trade, transportation, logistics, including also some other sector like financial sector. So this is a very encouraging development. But we should not complacent with this trend, because it is still very too early and too fragile for us to see the recovery path in the future, because the nature of the COVID is still here with us. Even though a lot of the hope and discussion about the vaccine invention, but it will take longer time for any country to be able to overcome this threatening COVID-19 vis-a-vis our objective to recover the economy. So Indonesia is going to also deal with this kind of uncertainty, even though comparing to many other countries in the world, our contraction of the economy on the second quarter at 5.4% relatively maybe mild comparing to many other countries who suffer even very deep contraction. It doesn't mean that we are all in a complacent situation. So going forward, we are going to continue to be very vigilant, especially with the weakening performance of corporations that definitely will affect the performance of the financial system, including and among the most important is banking system. Because to be honest, in Indonesia, the financial system is still very dominated by the role of banking system. And these are all the areas that the government, together with the Financial Stability Committee, will continue monitor and discussing and designing all necessary policy response in order for us to be able to facilitate as well as to mitigate, to facilitate recovery and to mitigate the risk which can come from this very fragile recovery after because of this COVID-19. I would like to say that the role of the deposit insurance is going to be very critical. I'm glad that we are discussing today in the form of what the deposit insurance could do to intensify their ability and their readiness to deal with the banking problem. Dealing with the banking pressure up to the ability to provide the resolution in the most efficient and credible way. I think this is one of the areas that all countries in the world is going to need to have this mechanism of maintaining stability but preparing for any eventually situation that will require us to be able to deal with potential banking resolution issue. This is the situation that for Indonesia is a very humbling, because even though Indonesia have already an experience in 97-98 of financial crisis, and in fact the Indonesian deposit insurance was created post those crises, we have to recognize that the situation back in the end of 1990 or early 2000 is totally different from today. And that's why some adjustment and pragmatism need to be continued to be adopted in terms of the way we are going to deal with this issue. I would like to close by saying that this international seminar is very useful and very timely for all of us to learn how other countries or globally its economy is going to respond to this still lingering issue and challenge of COVID-19, with their domino effect potentially affecting not only social economy, but also financial stability for any country in the world. This international forum will provide us with perspective as well as exchange of experience, and at the same time to learn from each other how step, action, policy, and instrument can be adopted when a certain economy affected by this COVID need to respond in a timely and effective way. Indonesia is already adjusting toward the mandate of the LPS, that is the Indonesian Deposit Insurance, in order for this institution to be able, together with financial supervisory authority, to deal with the banking problem in a very early stage. I do believe that this seminar will provide a lot of lessons learned and education for all of us to be able to improve further our preparedness to deal with any possibility development of this COVID-19 implication. So I wish you all have a very productive and constructive webinar, and in order for us to be able to learn from each other, so that for Indonesia especially, we will be able to continue improving our policy response and anticipation to what is going to still continue happen and very uncertain near future because of this COVID. Have a very productive seminar, and thank you very much for allowing me to give you this speech to set the tone for your discussion. Thank you. Very good evening, good morning, and good afternoon to all of you. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you very much, Minister Sri Mulyani, for delivering your keynote speech in our event. Ladies and gentlemen, we regret to inform you that Minister Sri Mulyani is unable to join us for the remaining sessions. Therefore, once again, we would like to thank Minister Sri Mulyani for taking time and speaking in our event. We will now kick off our discussion for tonight, highlighting the deposit insurance strategic responses and policy options in the midst of the current global pandemic. I will now hand over this session to Mr. Henry Wibowo, Executive Director, Head of Indonesia Research from JP Morgan, to moderate the exciting discussion ahead of us. But before I do that, allow me to remind you to submit your questions through Slido by scanning the QR code on your screen and type in the hashtag IDIC to start submitting your questions. Now let's welcome our moderator, Mr. Henry Wibowo. Mr. Wibowo, this session is yours.
Thank you, Tim. A very good afternoon, good evening, and good morning to all the participants. Welcome to Indonesia Deposit Insurance Corporation webinar, Maintaining Financial System Resilience to the COVID-19 Black Swan, Deposit Insurance Strategic Responses and Policy Options. My name is Henry Wibowo, and I will be the moderator of today's session. We are very honored to be joined by our three distinguished speakers that will be presenting in our upcoming panel discussion. We have Mr. Hassan Zaman, Regional Director, East Asia and Pacific for the Equitable Growth, Finance and Institution, Vice Presidency of the World Bank. We are also joined today by Mr. Arthur Merton, Deputy to the Chairman for Financial Stability, Federal Deposit Insurance Corporation, or FDIC. We are also joined today by Mr. Yuri Olegovich Isaev, General Director of the State Corporation, Deposit Insurance Agency of Russia. The format of the panel is going to be a presentation by each of the speaker for about 15 to 20 minutes, and then followed by the Q&A session. Before we begin, we would like to invite everyone to join our discussion tonight by submitting your questions through Slido. You can scan the QR code on your screen, where you will be then connected to Slido to submit your questions. We also seek your valuable input by completing a quick survey that has been prepared by the committee, and it is also available on Slido through the same QR code. For those wishing to retrieve the presentation on tonight's discussion, a separate QR code is available on your screen. You can scan the QR code and download the presentations. Now let's begin the first presentation of the panel discussion. Mr. Hassan Zaman, the screen is now yours.
Thank you very much, Mr. Wibowo. Good morning from Washington, D.C., and a very warm good evening to all colleagues in Indonesia. I'd like to extend a special thanks to Dr. Alam Shah, Chairman of IDIC, for extending this invitation, and to all the organizers of this seminar. I really look forward to participating and learning a lot myself. I'll be giving a presentation on the way we see things at the World Bank on global economic conditions and countries' responses to COVID-19. So perhaps we could move on to the next slide. And this is based upon the data that we've collected, as well as just some views that we have on financial sector responses in particular. Next slide, please. So I think what is quite clear is that this crisis is unprecedented. Now, we often use this word to describe many things, but the reason we really do believe it's unprecedented is if you look at the bottom right-hand chart, you see that over 90% of countries globally are facing a contraction, a negative growth in 2020. And if you look back at the last 140 years, which we have in this chart, it is the first crisis which is at this level, 0%. It was only in the 1930s where you saw something similar to this, but even in other recent crises, you've had a segment of the global, of the world, which has hit negative growth, but here you actually have this proportion. And what we see is that in general, about the growth contraction is about 7% for advanced economies, on average about 2.5% for emerging market and developing economies. So that's the general magnitude that we're looking at. So next slide, please. So at the World Bank, we focus more on emerging market and developing economies, and what are some of the characteristics that distinguish them from developed world economies? Well, first of all, there's more limited healthcare facilities, clearly, a higher dependence on external financing, deeper integration to global value chains, a reliance on commodity exports, especially oil, and particularly tourism and remittances, a much more limited fiscal policy space, as we'll discuss a bit later on. The importance, of course, of maintaining financial sector stability to avoid a worsening of the crisis. One has to balance those objectives out, and a large presence of the informal sector in the economy. That's what characterizes EMDs relative to developed world economies. Next slide, please. So in terms, if you look at growth numbers, and if you focus particularly on the East Asia and Pacific number, first of all, it's important to note that in 2020, on average, we're seeing probably about 0.5% positive growth in 2020, but that includes our number for China. If you exclude China, it is a contraction for the overall region, and most importantly, it is the lowest since the last 50 years in terms of growth. And that negative growth has significant spillover effects on employment and on increases in poverty as well. It is true that relative to other regions, East Asia will experience the least severe contraction in 2020, and perhaps the speediest recovery in 2021, according to our projections. Although I don't think that's a huge consolation given the sharp differences. The typical country in East Asia, so growth has gone down by about 5 percentage points compared to last year. And some countries have seen much sharper downturns as well. Next slide, please. And the point is that in East Asia, we are still heavily exposed to the world economy through the growth model that has been developed. And particularly countries like Vietnam, Cambodia, Malaysia, and Thailand are largely exposed with their heavy reliance on exports compared to some other countries which have a somewhat larger domestic market to sustain it, like China and Indonesia. So in relative terms, what our charts on exposure to trade and remittances show is that there's clearly variation within the region on the dependence on external flows as well. Next slide, please. And the slide that I want to end this first section on the global conditions is that clearly we also expect from previous experiences that there will be longer lasting implications of this pandemic. If you look at history, we know that pandemics have both demand and supply side shocks, and they affect productivity over the medium term and basically medium run growth as well. So, and that's because of depleted labor forces, weakened physical and human capital. Then on demand channels, just the lower business investment and consumer behavior, they have medium run impacts and that's been shown from previous pandemics as well as other types of crises where the cumulative loss of labor productivity of about 4% and investment by about 9% in a 3-year horizon on average. So next slide, please. So now if we turn to our global surveys that we've done on countries' measures for financial stability and economic recovery. Next slide. So they're basically divided into 3, which are monetary policy, fiscal policy, and macroprudential and financial sector policy. And we will go through each of these, and you'll see different examples. So if we move quickly onto the next slide. So what you see here, first of all, on the fiscal front. On the fiscal front, the average advanced economy has essentially put in packages which are worth close to 9% of GDP. And for EMDs, it's been about 3% of GDP. In this chart, which I'm not sure how clearly you can see every single country, you'll see that, for example, Indonesia's stimulus, it's sort of halfway through in terms of the size compared to other countries. And that's obviously that size of stimulus is largely about fiscal rules, fiscal space, and other considerations as well. But in addition to direct fiscal measures, there's also been significant off-budget liquidity support that's been provided, ranging from about close to 11% of GDP in advanced economies and about 2% of GDP in EMDs. Next slide, please. Then we've also seen very targeted and related, from within the fiscal package, industry and firm level policy measures, largely dominated by debt finance type measures, investment capital, tax breaks, support to specific business costs, retaining labor, etc. And what our chart on the right-hand side shows the sectoral breakdown of that. This is globally, of course, and we'll come to East Asia, is that a large chunk, about a quarter of them have gone to the tourism sector, for instance, a significant share to agriculture-wide, and then to manufacturing, and you'll see the breakdown on the right-hand side as well. But tourism clearly has been a sector which has been supported, quite rightly so, due to this pandemic. Next slide, please. On the financial sector side, what we've seen is that there have been over 3,000 policy measures taken by authorities in 156 jurisdictions, ranging from prudential measures, liquidity support, changes in the policy rate, supporting borrowers directly, adjustments to the payment systems, etc. And I'll break this down in East Asia, which I think might be a bit more of interest to our audience today. So next slide, please. And clearly, measures to do in the financial sector, many of them involve regulatory forbearance. Several of them are not aligned with global minimum standards. Therefore, they do pose medium run risks, and therefore they need to be carefully managed and unwound as the crisis unwinds itself, so as not to jeopardize future financial stability. If we move on to the next slide. Now, this one, I think, I like to spend a little bit. I'd like to pause a bit of time on this in terms of what have we seen within the East Asia region in terms of the measures that have been taken. And the charts over here give examples of countries as well as the extent of the measures, both on the fiscal, the income support, monetary policy measures, and financial sector measures. So what we've seen is that the fiscal policy measures essentially are helping households smooth consumption and firms to avoid bankruptcies. The rest, and what we see is that there's both direct spending as well as loans, equities, and guarantees as well on the fiscal support. And then in terms of the income support and revenue measures by beneficiary, we've tried to split this between individuals and firms, and mainly it's been individuals, households through social protection type measures who have got this support. As the Honorable Minister Sri Mulyani Indrawati also alluded to in terms of the interventions in Indonesia. And then there have been monetary policy support measures as well, right? So most countries, as you can see, have cut the policy rate. You've had reserve requirement ratios also been reduced. We've got asset purchases, which also have taken place, as well as other financial sector measures on the right-hand side, in the chart on the right. So next slide, please. So the final section in my last 5 minutes or so is to discuss some issues related to the policy considerations for maintaining financial stability. These are somewhat general views that we have for the countries, not specifically in East Asia, but globally. First of all, it's important to acknowledge that in this type of crisis, it is essential. Sometimes the rule book has to go out the window, and one has to respond, whether it's on the fiscal side and on the financial sector side. And so the short-term measures that have been trying to minimize the adverse long-term impacts. Sorry, next slide, please. Range from targeted liquidity support to ailing but solvent banks. Relaxation of macroprudential buffers, and that has been carried out in Indonesia as well as in other countries in Asia. And with the relaxation of the macroprudential buffers issue and loosening the capital liquidity requirements, is that it is important to always remind ourselves that relaxing. One should try and refrain from relaxing minimum standards that can raise moral hazard, lower transparency, and poor underwriting standards. And then the medium-term measures have related to strengthening the financial resilience of institutions and markets and strengthening bank resolution safety nets and crisis management frameworks. Next slide, please. Sort of our view is that, when we look at it from a financial sector perspective, and so the recommended framework for regulators and supervisors should relate to using the existing flexibility of the buffers in the regulatory and supervisory framework to facilitate well-designed public and private support interventions, minimize opportunities for moral hazard, and provide guidance on asset classification and provisioning. And then we have annexes in this presentation on the guidance from standard setting bodies, as well as maintaining the transparency and providing additional guidance on risk disclosure. Next slide, please. We also feel that one should suspend the automaticity of corrective supervisory action triggers, review supervisory priorities reflecting the risks and impact areas, coordinate actively with other relevant authorities domestically and internationally, and ensure the smooth functioning of critical market infrastructure, securities clearing, settlement, and payment systems. And final slide, please. And last, but by no means least, especially with the audience who is that we are in and are great partners in the Indonesian Deposit Insurance Corporation, let me say a word about the fact that effective financial safety nets are critical to maintain financial stability and to prepare for the aftermath of the impacts. The countries will need resolution tools in line with FSB key attributes, resolution planning aimed at preserving critical functions, clear triggers for resolution encompassing non-viability and insolvency, fully operational and well-funded deposit insurer, reliable funding mechanisms for liquidity and resolution purposes, legal protection for authorities in making difficult decisions, that is obviously a tricky one, and framework for information exchange with local and foreign authorities. So these are sort of our views as I wrap up this presentation, summarizing the way we see it in terms of the global impacts on growth, the impacts in East Asia in particular, the policy responses that have been entertained by a range of authorities, which vary clearly by the size and developed nature and extent of fiscal buffers. So the advanced economies have clearly been able to spend their way, I wouldn't say out of this crisis, but spend a lot more during this crisis than have emerging market economies, who are arguably navigating, therefore, a much, much more difficult waters with more limited space and of course more hard-pressed health systems. And the final part of the presentation related specifically on some issues towards maintaining financial stability. And I hope this has been helpful, and I look forward to the rest of the conversation and to listening to others. Thanks very much.
Thank you, Mr. Hassan, for the very insightful presentation. Before we move on to the next speaker, we would like to remind everyone again, if you would like to ask a question, please submit them through Slido. You can scan the QR code on your screen, where you will then be connected to Slido to submit your questions. We would like now to invite the second speaker in the panel discussion, Mr. Arthur Merton, Deputy to the Chairman for Financial Stability, Federal Deposit Insurance Corporation, or FDIC. Mr. Arthur, the screen is yours.
Good evening. On behalf of Chairman Yellen McWilliams and my colleagues, I would like to thank the Indonesian Deposit Insurance Corporation for inviting the FDIC to participate in this timely conference. I commend the IDIC for bringing us together virtually, and we are fortunate that technology allows us to work together at great distances. Before I begin my presentation, I would like to mention that this is not the first time that I have spoken to a large audience in Indonesia about deposit insurance. In 1993, 27 years ago, the FDIC was invited to speak at a conference in Bali where the government and others were exploring the possibility of establishing deposit insurance. And I was asked to represent the FDIC. That was one of the first outreaches that the FDIC had with other jurisdictions about deposit insurance. And I think it's fair to say that that helped kindle and bring about our engagement with other jurisdictions and led to the formation of the International Association of Deposit Insurers. And with that note, I'd like to, on behalf of my colleague Diane Ellis, she'd like to say hello to Fauzi Iksan, who is a fellow member of the Executive Committee of IADI. So I'm happy once again to be speaking to an audience in Indonesia about deposit insurance. And I would like to cover three areas today. The first is the US government response to the pandemic, especially how it relates to banking and deposit insurance. The second is how current events present challenges to our managing the deposit insurance fund. And the third is to describe how the the FDIC handled a bank failure in a time of social distancing and the challenges we faced there. So if we could turn to the slide deck, please. Perhaps go to the next slide. And the major action that the US government took in response was passing legislation known as the Coronavirus Aid, Relief, and Economic Security Act, or known as the CARES Act. This was signed into law at the end of March of this year. And it's really designed to provide support to small businesses, households, and protect jobs. And this was a large amount of support. It was approximately $2 trillion, which is 9% of GDP. So it was quite significant. An important part of this was what's known as the Paycheck Protection Program, or PPP, which provides loans to small businesses to continue their operations and to keep people on the payroll. And these loans are primarily delivered through banks, and they are guaranteed by the federal government. The CARES Act also had some specific provisions relating to banks. It gave them relief in terms of easing some accounting and capital standards and relaxing limits on lending. And these measures were designed to allow banks to better serve the credit needs of the economy. If I could have the next slide, please. In addition to the federal government and Congress acting, the banking agencies, the banking regulators, took some actions to address, allow banks to address some of the issues that the banks faced in light of COVID. We've begun conducting examinations, banking examinations, off-site through virtual bank examinations in order to divert the resources of the banks. We've delayed some reporting requirements. Banks are required to file quarterly call reports, and we gave them some additional time in filing their reports for their March reports. And we also took some actions to encourage banking organizations to use their capital buffers to provide lending and credit to their customers. If I could have the next slide. The CARES Act also provided a new authority to the FDIC, and this authority was similar to the measures that we took in the last financial crisis, when in 2008, we put in place two related programs, the Transaction Account Guarantee Program, or TAG, in which we provided unlimited deposit insurance coverage for non-interest-bearing transaction accounts. The second program was what we call the Debt Guarantee Program, where for the first time the FDIC guaranteed debt that was issued by banks into the market. Both of these were to provide financial stability, help stabilize the system during that difficult time. Now, while Congress in the CARES Act gave us this new authority, they did not mandate it. And in fact, they required that the FDIC board, in order to implement, would have to make a finding that a liquidity event had occurred that warranted the use of such a program. And the FDIC has not implemented that program, and largely because instead of facing significant liquidity pressures, banks are actually seeing quite a large inflow of deposits during this time. Another action that, if I could go back to the last slide, the FDIC also provided some relief to banks in terms of what they pay for deposit insurance. Because banks are participating in many of these programs to provide credit to the economy to help it recover, their balance sheets grow as a result of that participation. And normally that would have resulted in an increase in their deposit insurance costs, but the FDIC board acted to provide some relief to that. And then finally, the FDIC, since the middle of March, we have all been working remotely, mandatory telework, and that has been going better than we might have expected. Next slide, please. The FDIC has also initiated a public awareness campaign in light of COVID. We've launched a COVID-19 webpage that has frequently asked questions for financial institutions and their customers. And we put out a special edition of what we call the FDIC Consumer News that deals with the issues that have arisen in the pandemic. So if you're interested, I suggest that you visit our website and see what we've done there. Next slide. So let me turn now to the challenges that this has presented in our managing our deposit insurance fund. And I need to give you a little background here. The FDIC is required by law to maintain the deposit insurance fund at a certain level. And that level is determined by what we call the reserve ratio, which is the ratio of our deposit insurance fund, essentially how much money we have to deal with bank failures, the ratio of the deposit insurance fund to the amount of deposits we insure. That's what's known as the reserve ratio. And Congress has set a target of 1.35%, so that our deposit insurance fund must be at least 1.35% of the amount of deposits we insure. In the last financial crisis in 2008, we fell below the target at that time. And when that happens, we're required to put in place what is known as a restoration plan that shows that the reserve ratio will get back to its target in a certain amount of time. And in 2008, we had already had the most costly failure in the FDIC history, IndyMac, and we had other problems, and it was clear that we were going to be facing more bank failures. And we knew that it would require us raising premiums, raising the assessment rates in order to get back to the target within the amount of time that we were given. So we did have to raise rates during that time. What is happening now? If we could turn to the next slide, we have seen, perhaps not surprisingly, an enormous growth in deposits in the first half of this year. The reserve ratio at the end of last year stood at 1.41%, so we were above our target. Since that time, in the 6 months since then, with the large deposit inflow, we've had an increase of over $1 trillion in insured deposits. That's something like 15%. And that's essentially 3 years of normal deposit occurring within 6 months. So what has the impact of that been, or the implication? If we could go to the next slide. This shows our fund balance, which are the brown bars, and then the blue line shows the reserve ratio that I described. And it may be a little hard to see, but it shows that it peaked at 1.41% at the end of last year. And as a result of this strong insured deposit growth, it has now fallen to 1.30%. So we are below the target level of 1.35%. And as I mentioned, that requires that the FDIC put in place a restoration plan. And so we considered what to do there. And obviously, perhaps the most important aspect of this is that we are facing a great deal of uncertainty. It's unclear what will be the path for insured deposit growth. Will this inflow continue, or will it settle down to normal rates of growth? And then secondly, what will be the outlook for failures? We have not had significant losses from failures in recent years. And it's unclear what the impact of the downturn in the economy and the recovery, what the outlook for bank failures will be. So we're facing a great deal of uncertainty. And yesterday, our board, the FDIC board, acted to put in place a restoration plan. And that plan does not call for an increase in assessment rates based simply on 2 quarters of deposit growth. But instead, we committed to revisiting this every 6 months and more often if needed to see where we are in terms of the outlook for deposit growth and failures. And if action needs to be taken, it can be taken. You can see the analysis that the board based its decision on and the statements by our board members on our website, if you're interested. May I go to the next slide, please? Now I'd like to talk about handling a bank failure in a time of social distancing and during the pandemic. And go to the next slide. We were preparing for a failure of a bank in West Virginia at the beginning of this year. Again, could I go to the next slide, please? And you know, in terms of our typical handling of bank failures, usually we have some time before the bank is going to fail. We're aware that it's heading towards failure, and we use that time to try to arrange for an acquirer for the institution to do what we call a purchase and assumption transaction, where another bank would take over the assets and liabilities and operations of the failed bank. And we do that through establishing a due diligence process so that we can have access to the bank's records and loans, files, and so forth to allow potential acquirers to do their due diligence. That became more difficult once the social distancing was put in place. And so we had to accelerate the due diligence process. We set up a virtual data room. We use contractors after hours to upload files. And we've took other measures, and we were able to conduct a bidding process with potential acquirers. And if you go to the next slide, on April 3rd, the First State Bank was closed, and we were appointed receiver, and we resolved it through a purchase and assumption transaction. We had found an acquirer to take it over. So that was good news, but it still left an operational challenge for how do we actually make the transition to the new banks. You know, typically when a bank fails, we close it on a Friday evening, and we work through the weekend and open it on Monday with normal access, depositors having normal access to their funds. And even for small banks, that requires a lot of effort. In a failure like this, in normal times, we would have had 60 or so people on site. But obviously with social distancing, that was a challenge. So what our team did was send 10 people. We called them the Traveling 10. Our resolution people are headquartered in Dallas, Texas, and this was in West Virginia, over 1,000 miles away. So they drove there to the banking that was failing, and 10 people went on site. But we had on the order of 50 people or so working remotely and interacting with the on-site team to bring it to the work that needed to be done, transferring the records and so forth, and getting it in the hands of the acquiring institution. It turns out we also had concern for the safety of our staff and the bank staff and the acquiring bank staff. So we had a safety consultant, a health consultant, to help put in place measures to ensure the safety and health of the people involved. All in all, it went very well. We were very pleased with how it turned out. And it was important, we thought, that we have a successful resolution early in the pandemic, and in terms of maintaining confidence in the system. So with that, I'll stop there and look forward to the question and answer period. Thank you.
Thank you, Mr. Arthur, for the presentation. Ladies and gentlemen, we would like to remind again, if you would like to ask a question, please submit it through Slido. You can scan the QR code on the screen and you'll be connected to Slido to submit your questions. We will now move on to the third speaker of the panel session, Mr. Yuri Olegovich Isaev, General Director of the State Corporation Deposit Insurance Agency of Russia. The screen is yours, Mr. Yuri.
Thank you. Good evening. Greetings from Moscow. If we can move to the next slide, it would be nice. So first of all, I would like to thank IDIC and Chairman Halim Alamsyah for the invitation to speak at this webinar and to share our views on impact of COVID-19 pandemic on our country's economy, a national sector, and our operations in the capacity of a deposit insurer and bank resolution authority. Could you move to the next slide, please? The COVID-19 pandemic is influencing all countries, and Russia has not avoided this influence. Next slide, please. We have more than 1 million confirmed cases and passed the peak of the pandemic in May. As a result of lockdown and other measures that were implemented to contain the spread of the coronavirus, we expect that our country's GDP this year will fall by about 3.9%. As you can see on the graph, our GDP contracted in April by 10.8%. We see the growth of unemployment and the fall of disposable personal income, but currently the situation improves, and according to our government expectations, we will be able to reach positive GDP growth in 3 to 6 months. Next slide, please. The banking sector also faced some decline in profits and growth of NPLs. In May, bank profitability fell to almost zero, but starting from June, we see substantial improvement. At the same time, for us as deposit insurers, it's a good sign that deposits of both households and corporates have resumed their growth in the third quarter. Next slide, please. I have mentioned that some measures that have been implemented by our government to contain the spread of coronavirus. Starting from the end of January, Russia started to close its borders and impose mandated self-quarantine for those returning from abroad, as well as people at risk, such as elderly people and those who contacted infected persons. Our government declared non-working days regime from the 30th of March till the 11th of May 2020. During this period, it was requested for majority of the population to stay at home and limit their outdoor activities. Such measures as social distancing, masks, and sanitizers are still applied, while restrictions on operation of restaurants, fitness centers, cinemas, and public gathering have been weakened or abandoned. The government has deployed a plan to overcome the economic consequences of the COVID pandemic. Implementation of the plan is already underway. The first draft of the plan was presented in early June, and its official adoption is expected this month. In total, the plan implementation will cost our country about 5 trillion rubles, or 3.4% of GDP. It includes both social and business support measures. The social support measures that were introduced first in March-April include provision of support to those who have lost their jobs, families with children, elderly people. It should be noted that even when offices of government entities were closed in March, April, people continued to have access to majority of government services remotely through special website and applications. Next slide, please. The Bank of Russia is responsible for all aspects of financial industry regulation, supervision, and function. To support the economy during the coronavirus pandemic, the Bank of Russia has introduced a number of measures to support financial stability, facilitate lending, loan restructuring, affordable payments, and encourage investments. Among such measures, regular easing, liquidity support arrangement, special 500 billion ruble facility for small and medium enterprise lending, and reduced interest rate, widening of the list of collaterals for borrowings from the Bank of Russia. To encourage online purchases during the lockdown, the Bank of Russia imposed a limitation on the level of fees for such payments. It also allowed customers to open bank accounts remotely and continue to issue their bank accounts even when the ID documents expired. The Bank of Russia suspended inspection of financial institutions, extended deadlines for reporting and compliance with regulatory orders, not applied penalties for non-compliance with some regulatory requirements and the deadlines. Next slide, please. About our agency's strategic responses to the pandemic. During the lockdown, we quickly arranged work of our staff from home. We purchased notebooks and all-in-one computers and provided them to our employees, organized their encrypted connection to our internal IT infrastructure. We understand that the COVID-19 crisis can have serious adverse effects on our member banks. So we have enhanced monitoring of risk that we can face and updated our risk mitigation policy. We ensured timely payouts to depositors of failed banks. This year we have had 10 payout cases, including 7 in July, August. One of the measures that are to help banks to lend to the real economy was the decision of the agency's board of directors to decrease the level of premiums that member banks pay to the Deposit Insurance Fund, to decrease the basic rate 1.5 times. Our agency is implementing the strategy to make majority of our services available remotely through internet. And during the pandemic, it helped us to ensure uninterrupted services to depositors of failed banks. On our website, they can file claims, the status of consideration of their statements also available from the website. I have also successfully tested the possibility of remote payouts through agent banks without the physical presence of depositors in the banks. It's important to stress the necessity of constant coordination of our actions with other financial safety net participants, especially with the bank regulator, the Bank of Russia. The coordinated actions facilitate prompt payouts consistently of messages to depositors and banks that we want to deliver. The premium rate decrease is an example of such coordination. The decision was made jointly by all organizations represented in our board of directors. Next slide, please. About the challenges that we as a deposit insurer are facing. In May 2020, a new law was enacted that envisages higher coverage for temporary high balances resulting from sales of residential real estate, inheritance, social benefits, subsidies, etc. The coverage for such balances is up to 10 million rubles. The law also expands standards coverage of 1.4 million rubles to account of consumer cooperatives, real estate owners, partnership, religious organizations, charities, and other non-commercial organizations. These provisions that will be enforced starting from the 1st October, just in 2 weeks, are a recognition of importance of the deposit insurance system. And we need to make all necessary preparations to be ready to ensure effective operation of this new coverage. In July 2020, other 2 new laws passed that allow conducting financial transactions remotely through so-called financial platforms or marketplace. For such marketplace, consumers will be able to make financial transactions with different financial products issued by banks. What is important for us that the laws envisage special regime for deposit insurance payouts in relation to deposits placed via the marketplace. This will give us the possibility to speed up payouts. As some of you possibly know, due to the large number of payout cases in recent years, more than 300 banks failures, we exhausted funds accumulated in our deposit insurance fund and borrowed 842 billion rubles from the Bank of Russia. Up to now, we have repaid 391 billion rubles. We expected to fully repay the loan by the 2022, but our decision to reduce banks' premiums to the fund means that we will repay the loan later than expected. Next slide, please. One of the ways to facilitate prompt payouts is to make our communication with the depositors digital. I have mentioned to the marketplace where we will be able to make payouts very quickly. Other opportunities are associated with new services that we intend to deliver through various channels, including our website, the single portal of government services, remote channels of agent banks, and mobile applications. The next slide, please. Our agency has a broad mandate of a loss minimizer in addition to ensuring bank deposit and pension savings in non-government pension funds. We also resolve failing banks and liquidate failed banks, non-government pension funds, and insurance companies. With our history, we have been appointed as liquidators in 705 banks. We are constantly improving our assets marketing activities, and due to this level of satisfaction of failed banks, creditors' claims is growing. In average, we meet the creditor claims by 47.2%, including first priority claims by 67%, the claims of households. We also act as a resolution authority. Currently, we resolve 16 banks through open bank assistance tools. We have attracted new investors in their capital and provided financial support to such investors of banks under resolution. During the coronavirus pandemic, we ensured continuous implementation of all our projects and asset marketing activities. In addition to traditional asset sales, we are using various remote channels, including electronic asset sales through specialized platforms. We have created a special portal for asset sale on our website. I want to mention here a loan modification program that we launched during the pandemic. Borrowers of failed banks can remotely through their website apply for deferral of loan repayment for up to 6 months. Next slide, please. What are the main challenge for us as the resolution authority? I will mention just some of them. First, we make efforts to speed up the resolution and liquidation proceeding. I have discussed with the Bank of Russia and received the support of our initiative to start asset marketing at an early stage, at the stage of provisional administration that is appointed to the failed bank at the bank closure date. The current legislation allows us to do this only after the court appoints the agency as receiver or liquidator of the bank. We see some opportunities in optimizing our asset marketing activity. We would like to make arrangement for providing to potential purchaser of information about assets of a failed banks immediately after asset inventory. We also plan to use so-called Dutch auctions for speeding up asset sale and to improve our asset sale portal to make it more informative, convenient, and attractive for potential buyers. Bank resolution and liquidation is also a challenge from the point of view of publicity and transparency. Bank failures are influencing many people, businesses, and non-profit entities. And people want to know what is happening with their bank and their money. On our website, we disclose as much information about resolution and liquidation proceeding as possible. And now we're developing a dedicated portal for creditors of failed banks. And the last slide. And to conclude, I would like to point out some considerations that have emerged or confirmed their relevance during the recent pandemic month. The COVID-19 pandemic became a real stress test for us as deposit insurers and the financial safety net as a whole. They acknowledged the necessity to have the realistic business continuity plans and resources, financial, human, technical, IT, that will enable your organization to rapidly and effectively address emerging developments. In such situation as we're experiencing this year with the coronavirus, the role of financial safety net in general and deposit insurers in particular substantially increase. We protect our people and businesses' money, and they need to be confident in the safety of their funds. And I think such situation are a good opportunity for deposit insurers to initiate widening of our mandate or improving standing in the financial safety net. Our combined efforts and information sharing in the cornerstone of effectiveness of our policy response to any systemic turbulences. Thank you.
Thank you for the presentation, Mr. Yuri. Ladies and gentlemen, we would like to remind again, if you would like to join the discussion, please submit the questions through Slido. You can scan the QR code on the screen and use the hashtag IDIC as an event code. We would like now to move to the Q&A session by inviting the three speakers as the panel in the panel discussion. All right, seems like we have a few questions lined up already. The first question is coming from Lando. COVID-19 is a black swan, creates many difficulties, but green swan, Patrick Bolton, is disastrous. What is the DIC strategy to mitigate the green risk? Maybe this question we will direct it to Mr. Arthur Merton from the FDIC, as well as Mr. Yuri Olegovich Isaev from the Deposit Insurance Agency of Russia. Maybe we'll start first by Mr. Arthur. The screen is yours.
Yes, so if I understand the question, this is about climate change and the impact it may have on the financial system. Did I understand that correctly?
Yep, that's correct.
Okay,
it's the
good.
green risk.
Well,
yep.
Yeah, I have to say, you know, we in the U.S. we are spending some time thinking about this. I have to say we have not taken formal steps at the FDIC or in the broader financial regulatory community. You know, this is there are a lot of open issues there, and you know, I think the short answer is that we're in the early stages of thinking about this, and at this point, we haven't taken any significant steps to address that.
Thank you. We would like now offer the chance to Mr. Yuri to respond to the question.
Well, I can say that nowadays, because of this COVID situation, we are using less paper and we use more IT services. So this is the real impact on how we're working now. So I think it's a good question, but my opinion, we still should think about it. Maybe in our session also should be discussed. I think this is a good opportunity during this period to think about the multi-technology to avoid all this paper.
Thank you, Mr. Yuri. The next question is dedicated to Mr. Hassan. The question is, could you please comment on the trend of economic recovery in the Asia region post the reopening of the economy or the city lockdown since mid this year? Thank you.
Sure. So the way I would put it is that there are really two sets of countries. Ones which are emerging from the lockdown, which I would say would be the likes of China, Vietnam, which only had partial lockdowns, then Korea, Malaysia, Thailand. And then there are other countries which really are still in the midst of the COVID pandemic, which are when I would put Philippines, Indonesia, Fiji, those types of countries. So I think it's important to separate those out. First of all, in terms of the impact of the pandemic. And clearly with the former countries, we are seeing greater normalization of demand, of people back on the streets, normal trading. But they are also countries, especially like Vietnam and Malaysia and Thailand, which are heavily dependent on global supply chains and to trading conditions as well. So there will be there will be some rebound at the end of the day. When you have, we should always remember when we look at growth forecasts, say for 2021, that there is what's called the base effect, right? 2020 was low growth, so it's not too surprising to see much higher numbers for those countries. We certainly do see a pickup in China, for instance, and in Vietnam. And our projections for 2021 right now, we're still formulating them. But we expect some rebound, but there's a huge amount of uncertainty around that. And then for the latter type of countries, there we'll have to see how the pandemic unfolds. We still see some signs of recovery. Clearly, in many cases, the economy is still churning. There's a limited amount of time that people can remain at home. But clearly, it's not at the levels of the former set of countries, which sort of are much more active. Much more activity is going on. So that's the way I would classify it in terms of the recovery and looking ahead to 2021. Thanks.
Thank you, Mr. Hassan. The next question is for Mr. Arthur. Could you explain a little bit more on the power granted to FDIC in creating widely available debt program? How FDIC will run this program? Thank you.
Yes. So as I said, the authorities that we were given in the CARES Act allow us to put in place programs that are very similar to the programs that we put in place in 2008 during the global financial crisis. And the two types of programs were a program where we could provide unlimited deposit insurance for transaction accounts that were non-interest bearing. And this was largely targeted at large corporate accounts that were necessary for meeting payroll and so forth, so that if a bank failed, we didn't want to impose losses and create the disruption that that might entail. So we put in place an unlimited guarantee for those type of accounts. The second program that we had was the debt guarantee program, where banks could issue debt into the market that would be guaranteed by the FDIC. There were some restriction on this in terms of duration and amounts, but it went a long way to helping unfreeze the credit markets, because banks were able to raise funds in the market and attract the liquidity that they needed. So those are the two types of programs that we are given the authority to implement. But the FDIC has not implemented them, and it's probably not likely that we will implement them for two reasons. One is the banks are not facing liquidity pressures. The banks are receiving an inflow of deposits, as one of my graphs showed. And so the need for the program is not evident to us. And then also the CARES Act actually allowed us to put those programs in place, but only through effective year end of 2020. So we're getting near toward the end of the year. Congress would have to reauthorize this if we were to put something in place that went beyond the end of this year. So I hope that answers the question.
Mr. Arthur. We have the next question to Mr. Yuri. What are the key plans prepared by the Deposit Insurance Corporation? Sorry, I think the screen is, there's a technical. The question appears, yeah, sorry. Mr. Yuri, what are the key plans prepared by the Deposit Insurance Agency of Russia to ensure an efficient resolution process in handling the systematically important from the COVID-19 crisis? Thank you.
First of all, I mentioned that we decrease the level of payment for banks to the system, and we think that that gave banks opportunities to use money for create the real economy. And we made this decision about April, but started from the first quarter of the year. Second, we have our agreement with the Bank of Russia to provide us the substantial amount of money in case we needed more. And now we have a loan with the Bank of Russia, and in any case we can take and borrow money from the Bank of Russia. Well, next step for us, we are trying to provide more and more services for our customers on the internet, just to avoid the risk for people to go to banks branches. This we started this year, and this is a good experience for us. I think from the next year, this service will be provided through the government services, from our IT resources, from the IT resources of our banks agents. This is 3 key points that I wanted to mention now.
Thank you, Mr. Yuri. The next question is for Mr. Hassan. Earlier you mentioned that the GDP of the advanced economic actually saw a stimulus of about 9% of the GDP, and the emerging market is about 3% of the GDP. The question is, do you see a correlation between the stimulus as a percentage of GDP to the speed of the economic recovery of the respective countries? Thank you.
So there's no doubt that there is some correlation in that. At the same time, what is more important than share of GDP is the types of programs that have been put in place, the ability to target those resources to, if it's at the household level, to the right people who are suffering the most, and if it's to firms, the ones that are liquid but are illiquid but still solvent, and ones that and measures that in general have some sort of an end game to it as well. So I think that is important because the measures have varied quite a bit, and some certainly are more effective than others, and that is more highly correlated with recovery than the actual volume of the amounts which have been put in. So let me say that's my response to that. Thank you.
Thank you, Mr. Hassan. The next question is to Mr. Atta. Could you please further elaborate the special power given to FDIC to establish a temporary program to create a widely available debt program? Thank you.
I think that's the question that I answered just before. Should I go through it again?
Sorry, I think we can skip to the next one.
Okay.
I think the next question is to Mr. Arthur. Could you please share how is the financial system readiness between the current COVID-19 pandemic as compared to the 2008-2009 global financial crisis? Thank you.
Yes. Okay. Well, I think what I mentioned earlier was that I think there's quite a difference between the two episodes. As in 2008, risks had built up in the financial system, in banks and in other market participants, risks that weren't well understood. And those risks created losses and damage to the financial system and to the real economy, losses that outstripped the ability of the capital and liquidity resources of the banking industry and other parts of the financial sector to absorb those losses. And that created massive job losses and losses in output. And so really the direction, the causality was from the financial system to damage to the real economy. This time seems quite different from that. Banks entered this period with significantly higher capital levels that they've built up since the crisis of the 08 and 09. More liquidity in the system, in the banks. And so the banks, and we had not seen a buildup of risk that we had seen in prior to 2008. There may be some exceptions, but by and large, I think that's a fair assessment. And so the banks entered this period in much better shape, and the damage to the economy was not caused by the banking system as it was in 2008. Instead, it was this exogenous event, the coronavirus, which has had an impact on jobs and output, as other speakers have mentioned. But the banks entered this in a stronger position and are in a position to help with the recovery and to provide credit as the economy recovers. And so, as I mentioned, some of these government programs that are providing credit to households and businesses are operated through the banking system. And so I think, there's still more uncertainty about what will happen in the coming year and, how the recovery will proceed, and there is potential for possible banking problems and possible failures. But again, we entered this in a much better shape than we did in 2008. Thank you.
Thank you for the response, Mr. Arthur. The next question is coming for Mr. Yuri. The question is, when relaxing deposit insurance limit to provide larger guarantees to depositor, should we wait for a bank failure or should we raise it preemptively? Thank you. Sorry, Mr. Yuri, I think you're on mute.
No, it's okay, I think, yeah.
Yeah, all's good now.
That's a very good question. Thank you. I have now a big discussion here in Russia and the parliament. And for us, like deposit insurance, there are another question. Whether we have money to enlarge the coverage and to extend limits, or we do not have money. In the case when in the situation when we borrow money from the Bank of Russia, it's difficult for us to say that we need to increase the level of coverage. So I think that we should analyze every time the balance between the level of coverage and the real economy in the country. Nowadays, from our opinion, our levels of coverage is more or less okay and suitable to the current economic situation. From the point of view of the interest of deposit insurance system in general, I think it's better to go up with the level of coverage before the crisis, not to wait the crisis. Because when you do it during the crisis, you do it always under the press of customers, parliaments, and so on. So if you have the possibility to do it in advance, do it. This is my opinion.
Thank you, Mr. Yuri. The next question is coming for Mr. Hassan. What's your view if a government of a country made changes to the independence of a monetary or financial authorities to comply with fiscal objectives? Thank you.
Yeah, thanks very much. I mean, in general, there's been a lot of literature on this and a lot of practice on the merits of having central bank independence, the importance of having clear roles between fiscal and monetary policy, appropriate checks and balances between the two. And, whilst it always remains critical to coordinate between fiscal and monetary authorities, and to also have and in many cases in pursuit of shared objectives. So what is interesting is when you look at the mandate, for example, of central banks across the world, some are sort of very focused on the price stability objective. Others have dual objectives of both price stability as well as promoting economic growth. A few others also bring in exchange rate stability into the picture as well. And depending obviously on the type of economy, may not be possible to have all three, but anyway, the point is there are variations. But generally speaking, clearly, having there is a reason why why independence is valued and is important for any economy. And then the final thing I'll say is also there's the issue of what's de facto and de jure as well in terms of when you think about issues to do with independence, in the sense that You can have laws and legislations which sort of protect the independence, which are important, and then but then the actual implicit behaviors of those in charge of the various institutions also matter a lot in terms of the degree that is in fact implemented and exerted. So that's what I would say in terms of my thoughts on this issue. Thank you.
Thank you, Mr. Hassan. The next question is to both Mr. Arthur and Mr. Yuri. Considering the current conditions, would you agree that even a small bank may erode public confidence if the banks are allowed to fail? Thank you. Maybe we'll start with Mr. Arthur first.
Yes. So I don't know that I would agree with that. I think if a small bank fails and it's disruptive and people don't have access to their money quickly, there could be some concerns about the broader financial stability. But if we are able to handle the small bank failures as we have in the past, with typically a purchase and assumption transaction, and we close it on a Friday night, people have access to their money on Monday. In fact, they have access to it during the weekend through ATMs. And so we don't expect then that that will result in broader disruption. In the 2008-2009 crisis, we resolved over 500 banks with smaller banks with minimal disruption to their communities. And we think we have prepared to continue to do that. So I don't think in and of itself, I think there are ways to resolve a small bank in a way that doesn't create the broader disruption. And we hope we're able to continue to do that during this period. Thank you.
Thank you, Mr. Arthur. We'll now like to invite Mr. Yuri.
Well, for us, the biggest problem, not the size of the bank. We have now past our experience when we have more than 700 cases. Problem is not the size of the bank. The problem is the quality of assets inside the bank, because we could have a small bank with more or less normal assets, and we had now practice big banks with very, very bad assets. This is the main problem for us, like a liquidator authority. And, I think that the biggest question for us is to cooperate with the controlling body, with the Bank of Russia, first of all, because when the supervision there becomes stronger and stronger, for us, there is not a problem to work with small, medium, or big banks. And I know for sure that in some regions of Russia, it's better for people to work with small, medium-sized banks. So for me, the biggest challenge now is to be sure in the controlling procedures from the Bank of Russia. And when we enter the bank, first of all, we have to have the normal assets inside. This is our problem for the moment. I think we need another 3-4 years just to take off from the market this not really banks. After this, maybe we'll come back to the normal functioning like a deposit insurance agency. I mean, we'll be able to collect money from banks and just to work in the more or less normal situation, not in urgent like we used to do during 7 past years.
Thank you, Mr. Yuri. In the interest of time, we would like now to conclude the Q&A session. For those who still wish to ask the question, please feel free to email ghin@lps.go.id, and the LPS team in Indonesia will gladly respond to the questions. Once again, Mr. Hassan Zaman from the World Bank, Mr. Arthur Merton from Federal Deposit Insurance Corporation, and Mr. Yuri Olegovich Isaev from Deposit Insurance Agency of Russia. Thank you so much for your time, and we really enjoyed the presentation. We found it really insightful. On behalf of the Indonesia Deposit Insurance Corporation, thank you again. Stay safe and stay healthy. I would like now to pass on the session back to the host. Thank you.
Thank you very much to all speakers and also our moderator for providing a very valuable insight to all of our participants tonight. Ladies and gentlemen, we have finally reached the end of the IDIC International Webinar. May I remind you once again, if you wish to download the presentations from the discussion, you can scan the QR code on your screen or type in the web address provided. We also invite you to complete a quick survey that is available through Slido, as your valuable input is important to us. And lastly, also once again, if you have any remaining questions on the event or the discussed topics, you may contact ghin@lps.go.id. We thank you for your attendance. We hope to see you again in the next IDIC International Webinar. My name is Timothy Marbun. Stay safe and stay healthy.